Welcome to Pooled Investments. This module explains how mutual funds, exchange-traded funds, closed-end funds, and unit investment trusts turn many investors' dollars into diversified portfolios. We will separate the investment strategy from the legal wrapper, calculate net asset value, compare daily and intraday pricing, and examine fees, taxes, turnover, and performance. Several examples update the original chapter with current fund industry data, the modern names rule, target date glide paths, and current evidence on active management. We will also add a few market anecdotes and light humor because expense ratios are easier to remember when they stop looking like harmless decimal dust. Suppose you want broad stock market exposure for a long-term goal. Your brokerage screen offers an index mutual fund, an exchange-traded fund that tracks the same index, and a target date fund that owns several funds. The underlying securities may overlap, yet the buying process, pricing, rebalancing, trading costs, tax behavior, and investor workload differ. This chapter asks you to choose at two levels. First, what investment strategy fits the goal? Second, what structure delivers that strategy efficiently? The wrapper is not the investment idea, but it changes how the idea reaches your account. By the end of this module, you should be able to do 5 things. First, explain why pooled investment vehicles create value through diversification, divisibility, administration, and professional management. Second, compare open-end mutual funds, closed-end funds, ETFs, and unit investment trusts. Third, calculate net asset value and distinguish NAV from a market price, premium, discount, and bid-ask spread. Fourth, evaluate investment policies, target date glide paths, active and index approaches, fees, turnover, and taxes. Finally, use a repeatable due diligence framework to judge whether a fund fits an investor's objective rather than merely winning a recent performance contest. 5 questions organize the chapter. Why pool money at all? Which legal and trading structure holds the portfolio? What strategy does the fund follow? What costs and taxes reduce the investor's return? And how should performance be evaluated? These questions are connected. A low-cost wrapper cannot rescue a poor strategy, while a good strategy can be undermined by high fees, inefficient trading, or an unsuitable tax location. Performance must be judged against the correct benchmark and over a period that reveals both results and risk. Use this map to keep the product label, portfolio, and investor outcome in the same picture. Investment companies solve practical problems that would be expensive for many individuals to solve alone. Pooling makes a diversified portfolio divisible into affordable shares. The fund keeps records, values the portfolio, processes purchases and redemptions, distributes income, and provides statements and tax information. A professional advisor can research securities and implement a defined policy. Scale may reduce trading and custody costs, although investors still pay fund expenses. The key economic idea is shared infrastructure. Instead of every investor building a tiny private back office, the fund operates one system for many shareholders. A pooled fund has 4 moving parts. Investors contribute cash and receive fund shares. The fund or trust owns a portfolio of securities. An advisor or sponsor follows the stated strategy, while service providers handle custody, accounting, transfer agency, and distribution. Dividends, interest, realized gains, and changes in market value flow back to shareholders through distributions or changes in share value. Net asset value connects the portfolio to each share. The fund is therefore both a portfolio and an operating organization. 2 funds holding similar securities can still produce different investor experiences because their structures, fees, taxes, and trading mechanisms differ. The U.S. open-end mutual fund recently passed a 100-year milestone. Massachusetts Investors Trust opened in Boston in 1924 and offered ordinary investors professional management, diversification, and redeemable shares. The idea sounds routine now, which is usually what happens after an innovation wins. In 1976, Vanguard launched the first index mutual fund for individual investors. It raised only a little more than $11 million and was mocked as a sure path to mediocrity. The supposed folly eventually became a default approach for millions. Market history has a sense of humor, although it rarely sends the joke in advance. An open-end mutual fund continuously issues new shares and redeems existing shares. Investors transact with the fund or through an intermediary rather than trading shares with another investor on an exchange. The transaction price is based on the next net asset value calculated after a properly submitted order is received. That is called forward pricing. A buy order placed at noon does not lock in the noon portfolio value. It receives the next calculated NAV, usually after the major U.S. exchanges close. The structure is convenient for automatic contributions and fractional shares, but it does not provide intraday control over the execution price. A closed-end fund generally sells a fixed number of shares in an initial offering, and those shares then trade on an exchange. Investors buy from and sell to other investors, so the market price can differ from the portfolio's NAV. A fund trading above NAV is at a premium. One trading below NAV is at a discount. The discount can widen even when the portfolio has not changed much, which adds a second source of volatility. NAV and market price are related, but they are not required to agree. Think of them as two economists sharing a spreadsheet, usually connected, occasionally argumentative. An ETF combines a pooled portfolio with exchange trading. Retail investors buy and sell ETF shares throughout the day at market prices. Large authorized participants can create ETF shares by delivering a specified basket of securities or cash to the fund, and they can redeem large blocks for a basket. This creation and redemption process helps connect the trading price to the value of the underlying portfolio, although premiums and discounts can still appear. The ETF structure can offer intraday flexibility, transparency, and tax advantages, but the investor must also manage spreads, order types, and trading conditions. A unit investment trust, or UIT, holds a generally fixed portfolio for a stated period rather than employing an advisor to trade continuously. Units are sold to investors, and the trust may terminate on a defined date. The fixed design can make the portfolio relatively transparent and reduce discretionary management, but it also limits the ability to respond to changing conditions. A UIT is closer to a pre-assembled investment package than an actively managed portfolio. Set it and forget it is memorable, but the phrase should never be confused with free it and ignore the prospectus. The four structures answer different operational questions. Mutual funds transact once daily at NAV and are often convenient for automated investing. ETFs trade intraday and use creation and redemption to connect market price and portfolio value. Closed-end funds trade intraday but can maintain persistent premiums or discounts because investors cannot normally redeem shares directly at NAV. UITs hold a largely fixed portfolio for a defined life. None is universally superior. The best structure depends on the strategy, trading frequency, tax situation, account type, desired automation, and the investor's ability to use exchange orders effectively. Not every pooled vehicle is a registered mutual fund or ETF. Collective investment trusts, sometimes called commingled funds, pool assets for eligible retirement plans and institutional investors under a different regulatory framework. REITs are operating or financing companies that own real estate or real estate debt and often trade like stocks. They are not simply another share class of a mutual fund. Hedge funds and other private funds use exemptions that limit who may invest and can employ concentrated illiquid or leveraged strategies. The lesson is to ask which rulebook applies. Similar sounding pools can differ sharply in disclosure, liquidity, eligibility, valuation, and investor protections. Net asset value begins with a balance sheet. Suppose a fund owns securities and cash worth $100 million, owes $5 million in liabilities, and has 10 million shares outstanding. Total NAV is $95 million. Dividing by 10 million shares gives a per share NAV of $9.50. If portfolio values rise by $1 million with no other changes, per share NAV rises by 10 cents. The calculation is simple. The difficult work is valuing the assets accurately, accounting for liabilities, and applying consistent policies when markets are closed or securities are difficult to price. NAV is the portfolio value per share, but not every investor transaction occurs exactly at NAV. Open-end mutual funds generally buy and redeem at NAV, adjusted for any applicable sales charge or redemption fee. ETFs and closed-end funds trade at market prices. If an ETF has a NAV of $50 and trades at $50.10, it is at a 20 basis point premium. A buyer may also cross the bid-ask spread. In calm, liquid markets, these differences may be small. In stressed or less liquid markets, they can widen. The wrapper therefore changes the path from portfolio value to the investor's execution price. A fund's wrapper and its investment strategy are separate decisions. An S&P 500 strategy can be delivered through a mutual fund or ETF. A municipal bond strategy can appear in an open-end fund, closed-end fund, or ETF. An active strategy can also use either a mutual fund or ETF wrapper. The wrapper governs share issuance, redemption, and trading. The strategy governs what the portfolio owns and how it is managed. Confusing the two can lead to poor comparisons, such as comparing an active small-cap ETF with a passive large-cap mutual fund and attributing every difference to the wrapper rather than the underlying exposure. Equity funds can be organized along several dimensions. Broad market funds hold many industries and companies. Style funds emphasize growth, value, or capitalization range. Sector funds concentrate in one industry and therefore offer less diversification. Global funds may include U.S. and foreign securities, while international funds generally focus outside the United States. Regional and emerging market funds add currency, political, liquidity, and governance exposures. A fund category is a starting point, not a risk score. A diversified foreign stock fund and a concentrated technology fund may both be called equity funds, yet they solve very different portfolio problems. Bond funds differ by maturity, duration, credit quality, sector, tax status, and geographic exposure. A short-term treasury fund is not interchangeable with a high-yield corporate fund simply because both hold bonds. Money market funds invest in short-term instruments and seek liquidity and capital stability, but they are investment products rather than bank deposits and are not insured by the FDIC. Current rules require stronger liquidity buffers, and certain institutional prime and tax-exempt money market funds can impose liquidity fees after large net redemptions. The word cash-like is useful. The word cash is too confident. Balanced and asset allocation funds combine stocks, bonds, and sometimes other assets in one portfolio. Some maintain a relatively stable mix. Others shift weights according to a policy or forecast. A fund of funds invests primarily in other funds, which can provide broad diversification and simplify rebalancing. The investor should still examine the underlying exposures and the combined fee structure. A one-ticket portfolio can be convenient, but convenience is not the same as simplicity. If the fund owns 10 other funds, the wrapper may be tidy while the ingredients resemble a financial lasagna. Target date funds combine multiple asset classes and change the mix over time. The target year usually corresponds to an expected retirement or goal date. The planned shift toward a more conservative allocation is called the glide path. A to glide path reaches its most conservative mix near the target date. A through glide path continues changing after the date. Two funds labeled 2060 can therefore hold different stock percentages, use different underlying funds, and charge different fees. The year in the name is a navigation marker, not an autopilot certificate. Investors must still examine the glide path and their total household allocation. Active and index funds perform different jobs. An index fund seeks to track a benchmark before expenses and accepts the benchmark's composition. An active fund gives a manager discretion to select securities, vary exposures, hold cash, or manage risk differently from a benchmark. Active management may add value, especially in some market segments or through risk control, but the benefit must exceed fees, trading costs, taxes, and manager selection risk. Indexing offers broad exposure, transparency, and predictable benchmark relative performance, but it does not eliminate market risk or valuation risk. The choice should follow the investor's objective, not a team sport loyalty test. A fund name is useful packaging, but it is not an X-ray. The SEC's modernized names rule generally requires funds with names suggesting a particular investment focus or characteristic to adopt a policy to invest at least 80% of assets consistently with that name. The rule now reaches terms such as growth, value, and certain thematic characteristics. Even so, The remaining portfolio, derivatives, cash, definitions, and implementation choices still matter. Investors should read the investment objective, principal strategies, holdings, and risks. A label can narrow the search. It cannot complete the due diligence. The U.S. pooled investment market is enormous and diverse. At year-end 2025, equity, bond, and hybrid mutual funds held about $23.6 trillion. Money market funds held about $7.7 trillion. ETFs held about $13.4 trillion, traditional closed-end funds about $257 billion, and UITs about $103 billion. Together, investment companies held roughly $45.1 trillion, with ETFs representing about 30%. The scale helps explain why small differences in cost, tax efficiency, and investor behavior can translate into very large aggregate outcomes. ETFs have moved from a niche structure to a major share of the fund market. By year-end 2025, the United States had about 4,495 ETFs with $13.4 trillion in assets. Growth has expanded the menu beyond broad stock indexes to bonds, factors, options-based strategies, commodities, and active portfolios. More choice can improve access, but it also raises the burden of classification. An ETF is a delivery vehicle, not a quality seal. The ticker may be short, the prospectus is not. Investors should understand the underlying exposure, trading behavior, counterparty structure, and role in the portfolio. A fund's total cost has several layers. The expense ratio pays for investment management and operating services from fund assets. Shareholder fees may include sales loads, redemption fees, or account charges. ETF investors can face brokerage commissions, bid-ask spreads, premiums or discounts, and market impact. Investors may also pay an advisor or platform fee outside the fund. Taxes can be the largest variable in a taxable account. The published expense ratio is essential, but it is not always the entire cost. A useful habit is to ask who is paid, when the cost is charged, and whether it appears in the prospectus fee table. Small annual fee differences become large over long horizons because fees reduce the amount left to compound. Suppose $10,000 earns 7% before fund expenses for 30 years. With a 0.2% annual expense, the ending value is about $71,968. With a 1.5% expense, it is about $49,840, a difference of more than $22,000. The market return was identical. Fees are quiet roommates. They rarely make a scene each year, but after 3 decades, you notice how much of the apartment they occupy. Mutual fund share classes can hold the same portfolio while charging investors differently. A front-end load is deducted when shares are purchased. A contingent deferred sales load may apply when shares are sold during a specified period. A 12b-1 fee is an annual distribution or service fee paid from fund assets. Different classes can therefore suit different holding periods or advisory arrangements, but comparisons must include both the sales charge and ongoing expense. Breakpoint discounts may reduce front-end loads for larger investments. A load is a toll booth at the entrance or exit. It does not make the portfolio's road any faster. Consider a fund with a public offering price of $10 and a NAV of $9.50. The 50-cent difference is the front-end sales charge. As a percentage of the $10 offering price, the stated load is 5%, but only $9.50 is invested, so the charge equals about 5.26% of the money actually working in the portfolio. This distinction explains why the effective load relative to invested capital can be higher than the quoted percentage. Always identify the denominator. Finance has many disagreements that are really denominator disputes, wearing expensive suits. A commission-free ETF trade can still have costs. The buyer normally pays the ask, and the seller receives the bid, creating a spread. The ETF may trade at a premium or discount to NAV. A large order can move the market, especially in a thin fund or when the underlying securities are less liquid. An investor can also choose a poor time, such as the first few minutes of a volatile session when spreads may be wider. Zero commission means one line item is zero. It does not mean the total trading cost has entered a witness protection program. Limit orders and liquidity awareness can improve execution discipline. Portfolio turnover measures how much of a fund's holdings are replaced over a year. Higher turnover can reflect an active strategy, changing opportunities, index reconstitution, flows, or risk management. It can also increase brokerage costs, market impact, and realized taxable gains. Turnover alone does not identify a bad fund. A low turnover strategy can still be expensive or poorly designed. The key is consistency. Does the turnover match the stated process, and has the strategy delivered enough value to justify the costs? Hidden costs are not invisible in economic results. They simply appear later in performance and taxes rather than in a single fee line. A mutual fund can distribute dividends and capital gains generated inside the portfolio. In a taxable account, those distributions can create taxable income even when the shareholder did not sell fund shares. An investor who buys shortly before a capital gain distribution may receive cash or reinvested shares in a tax form soon afterward. It can feel like receiving a tax bill for a party you did not attend. The distribution is not free return because NAV usually falls by the distribution amount. Taxes depend on account type, holding period, income category, and personal circumstances, so tax analysis should be coordinated with appropriate professional guidance. ETFs can be relatively tax efficient because authorized participants may receive securities in kind when redeeming creation units. That process can allow the portfolio to remove low-basis securities without the same taxable sale that an open-end mutual fund might make to raise cash for redemptions. The advantage is potential, not a guarantee. ETFs still distribute dividends and can distribute capital gains. Tax efficiency also depends on the asset class, portfolio turnover, derivatives, rebalancing, and investor trading. A tax-efficient wrapper cannot turn a high turnover strategy into a tax-free strategy. Structure changes the mechanics. It does not repeal the tax code. Current performance evidence illustrates how difficult active management can be. In 2025, 79% of active large-cap U.S. equity funds underperformed the S&P 500. Results varied by category, and active managers had better outcomes in some segments, but underperformance rates generally increased over longer horizons. The correct conclusion is not that every active fund fails. It is that the starting odds, fees, benchmark choice, and manager selection challenge must be taken seriously. A fund's recent winning streak is evidence to investigate, not a permission slip to extrapolate. The rearview mirror is useful, but it should not be installed where the windshield belongs. Performance persistence is even harder than one-period outperformance. The 2025 U.S. Persistence Scorecard found that, with the exception of small-cap funds, none of the top quartile active domestic equity funds from 2021 remained in the top quartile through 2025. Only 2% of top quartile small-cap funds did so. Funds that perform poorly are also more likely to merge or liquidate, creating survivorship bias in simple historical comparisons. A strong manager may exist, but identifying skill requires evidence about process, people, capacity, costs, and repeatability. Rankings are a starting signal. Persistence is the harder test. A practical fund review begins with fit. Identify the objective and the role the fund should play. Then examine the benchmark, holdings, concentration, duration or credit exposure, and the sources of return and risk. Compare the expense ratio, shareholder fees, trading costs, turnover, and tax characteristics. Review the manager or index methodology, governance, assets, liquidity, and capacity. Finally, judge performance over multiple market environments using the correct benchmark and risk measures. This checklist turns fund selection from a beauty contest into an underwriting process. The best fund is not the one with the most impressive brochure. It is the one that reliably performs the intended job at an acceptable total cost. Apply the framework to 3 choices for a long-term retirement saver. Fund A is a broad index mutual fund with automatic monthly investing, a low expense ratio, and end-of-day pricing. Fund B is an ETF tracking the same index with a slightly lower expense ratio, but a wider spread in small trades. Fund C is a target date fund that costs more, but provides global diversification and automatic rebalancing. There is no universal winner. The best answer depends on the account, contribution process, desired allocation, tax situation, trading size, and willingness to rebalance. A few basis points matter, but so does a system the investor can actually maintain. Pause here and answer the 4 questions. First, which structure normally creates and redeems investor shares directly at NAV? Second, what does a closed-end fund discount describe? Third, why can 2 target date funds with the same year behave differently? Fourth, which costs may exist in a commission-free ETF trade? The answers are 1. An open-end mutual fund. 2. The market price is below NAV. 3. Glide paths, holdings, and fees can differ. 4. The bid-ask spread, premium or discount, market impact, and taxes can still matter. Carry forward 6 ideas. Pooling makes diversification and administration divisible. The wrapper determines how shares are issued, redeemed, priced, and traded. The strategy determines what the portfolio owns. NAV is the portfolio value per share, while market price can include a premium, discount, and spread. Fees, turnover, and taxes compound against the investor. Finally, performance must be judged against the right benchmark with attention to persistence and survivorship. The next module will formalize return and risk measurement. Before publishing this chapter, generate the slide-by-slide narration with your personal voice, review the anecdotal slides for pacing, and provide the transcript and captions with the LMS video.